Welcome to Retail Retold, the stories behind how that store landed in your neighborhood. I'm Chris Ressa, in conversation with the people and stories shaping retail and real estate. Brought to you by DLC. Welcome to Retail Retold, everyone. I am excited. Today I am joined by DLC CEO Adam Ifshin. We don't always get the pleasure, but I'm pumped you're here today, Adam. Welcome to the show.
Thanks, Chris. Thank you for having me. It's not like I haven't spoken to you 100 times already today.
I know we have spoken a lot today. We got an early start today. Got an early
We
start today.
certainly did.
Um, well, we're leading into ICSC Las Vegas. Some have dubbed the Super Bowl of retail real estate. It's a big time of year for our industry, and it brings a lot of people together to hopefully accelerate uh, deal making in all aspects of deal making. And going into it, DLC has started to build a cadence around putting out some interesting research around the industry specific to what we're seeing. We've done a couple now, and every year we're starting to get into this rhythm where we put one out, and we have one coming out. By the time you're listening to this, everyone, you might have seen it. It's called Too Good to Ignore, and it's a macro level of our take on the state of the industry. What do you think of this year's white paper that we put out?
Well, first of all, on the eve of my 32nd ICSC Las Vegas, I can't remember a time where I felt more both excited and optimistic about the overall state of the industry, its fundamentals, retailer health, retailer vibrance. And it was very easy this year to think about what would be in our white paper, which is called "Too Good to Ignore," because the reality is that everything in the industry is firing on all cylinders in my view right now. So what do I mean by that? If you think about the four things that really make retail real estate go from an investment performance perspective, all four are growing and moving in the right direction at the same time. Something that, quite candidly, probably has been a rarer thing than I would have liked it to have been on the eve of the many Las Vegases that I've attended. And those four things are traffic, sales, occupancy, and rent growth. And it's a wonderful time in our industry in all four.
Well, that that is fantastic news. It is a wonderful time on all four. We do have the backdrop, not to be Debbie Downer. We do have the backdrop of the capital markets, which has made it an interesting time because typically when those four things are going well, property prices are skyrocketing.
Yeah, so without question, right, there's a disconnect at the moment between the capital market space and the fundamentals on the ground. But as a long-term operator, value creator, and the steward of leading DLC, I'm okay with that. This is when the capital markets are easy, it's very hard to separate the pretenders from the real stars. When the capital markets are more challenging, more disrupted, I think true talent, the value of your human capital, the value of the teams that we work so hard to build come to the fore. And that's what we're seeing now. You can't take advantage, obviously, of the four things we discussed at the open without the availability of capital. But we've been able to access capital consistently for the things we wanted to do. And we're well on our way to having a big, big, big year in terms of both buying and selling and refinancing. And it hasn't been easy. It's very demanding for sure. But I think you have to separate out. We were on a call this morning about an asset we're very likely to acquire, and the seller's making their choice of who's going to buy the asset or have an opportunity to buy the asset, not purely based on price, but who has the highest probability of being able to execute. And in this type of market, I think that's advantage DLC.
I love that. Hold those thoughts. That's really interesting. This concept of when the markets are a little more challenging and volatile, that's when the true talent shows up. And you'd rather have, if you had your choice, you'd rather have the fundamentals at the property level be as strong as they are today than have great capital markets, but very poor retailer performance and fundamentals at the property level. Is that fair?
100 out of 100. You do realize you just asked me to stop talking. How many times have you gotten away with that in close to 20 years? Just kidding.
So, okay. So bringing it back in, we got this paper coming out, Too Good to Ignore. And one of the things we cover that's not unique, but I think we have a unique take on it is what's going on with supply and demand. I think we were one of the firsts to come out and really push what was going on a couple years ago as related to supply and demand. Now it's the buzz of the entirety of commercial real estate, this supply and demand, uh, challenge for an opportunity in retail real estate. So I think what's interesting about the supply and demand is what are the implications from your take of where we are today and what that means for the future with the supply and demand of retail real estate?
I think you have a couple of you have two big macro factors at work as it relates to supply and demand. You know, the supply and demand coming in balance is not a new phenomenon. The industry has gained a level of hard fought, hard won discipline as it relates to new development over a very long period of time. We have built far less space and delivered far less space all the way back to the end of the global financial crisis than has been historical demand. So the available pool after you remove things that become structurally obsolete, dead malls, dead department stores, et cetera. When you move all that, the supply is shrinking and the supply of quality open air retail real estate. I think that's the operative word is quality, Chris, is shrinking. And now the impact of that is really coming home to roost. As you like to point out, we've done over 120 big box deals at DLC in the last 6 years. And we have eaten up an immense amount of the available space in the marketplace. Now, all of a sudden, there's demand and retailers need and want stores. I mean, remember, opening new stores is still the best, most efficient, most cost effective way for retailers to grow their businesses. Hands down, not open to question. But now the combination of a five sigma move in interest rates and a mammoth increase in construction costs over the last 3, 4 years has made it, uneconomic from a rent perspective to deliver new space, even though the retailers need it and want it. So that is placing now, I think, very significant upward pressure on rents. And I believe we're only in the very, very beginning of that game. We're in the second or third inning of supply and demand favoring the landlord for the first time in a very long time in the industry. And as a result of that, I think there's a long runway. You can't just flip a switch and deliver a 300,000 square foot new shopping center in 6 or 9 or 12 months. All of a sudden, there's tenant demand. Even if the economics of that model worked, and today they don't, right? Because that would generate rents in the 30s for box tenants, which doesn't really work, as we know. The reality is there's a long gestation period, right? Elephants give birth to herds faster than municipalities provide entitlements, and we can build new space. So as a result, I think we're looking at a fairly long runway here of significant and meaningful rent growth.
I didn't think we were talking about elephants giving births to herds on this show today, but here we are. So, well, let me ask the dumb question. Why don't we just build more?
So it's just the answer is it's flat out too expensive, right? I mean, in today's day and age, I think if you were to honestly sit down with a really talented developer, and we know plenty of them, I think you're looking at $400 a foot. So if you build to an 8.5 unlevered, you're talking about $35 rents. just to get to sort of a reasonable rate of return. It's a rare location that supports $35 in box rent. So I think that's and then on top of that, right, retailers still need to put their own fixtures and FF&E and other finishes in the space. So I don't, the math doesn't work. And I think, look, the supply continues to come out of the system. We're buying, as you know, a dominant power center in a top tier market in New England. And you look around and 100,000 feet came out of the system and became a healthcare facility. 70,000 feet came out of the supply and went from being a former supermarket to being a self-storage facility. 160,000 square feet of GLA at a mall was knocked down and replaced by 280 units of multifamily. Other uses are competing, and some of those other uses, not all of them, but some of those other uses can afford to pay higher rents, and that's adding pressure to shrink the supply available and force rents up.
So you say second or third inning in this rent growth phase that we're about to go through. No one can predict how long, right? If we knew exactly how long or what, no one can predict. But what I do think is fair is, do you think we will eventually reach a point where where now it starts to go, if that's what it is, we might as well build new?
Oh, I think there's no question that there will come a day. I just don't think that that day is anywhere near around the corner. Right now, I think you see if you subscribe to my view that replacement cost is $350 to $400 a foot, fully loaded today, and the average shopping center trade is done in the high 100s, low $200 per square foot. You're 50% ish of replacement cost. So rents have a ways to go to get to a place where they will incentivize meaningful new development. Now, I think there will be some places where new development occurs sooner than that. Those will be places where you have very pro-development municipalities who want to encourage certain forms of new development, whether that's grocery anchored or value, et cetera, who are willing to, via TIFs, pilots, and other tax increment type financing structures, make dollars available for developers to offset the extremely high cost it takes right now to open a site and deliver a site. So I think you'll see some earlier. I hopefully we'll see it in some underserved markets. I think you'll see it in some growing markets where municipalities have the tax revenues to bypass them and direct them towards specific projects. But those things are generally going to be very small on a macro level in terms of, the amount of square footage that that's going to deliver relative to what the market demand for space is at the moment. And I think a lot of retailers, much like homeowners who have that 3% mortgage and they're reluctant to give it up, a retailer who's holding a lot of below market options is probably going to be pretty reluctant to give up that space. They're gonna try to figure out how to remodel that space, get more productive in that space, get more efficient in that space, and try and stay there because it behooves them, to have a below market rent as long as possible from their own four-wall EBITDA calculation.
For sure. I think I agree with everything except I'm not sure I'm there on 350 to 400 a foot.
You think it's more or less?
I think the true cost is more, uh, and for a lot of reasons. One, I'm yet to find a site where the site work doesn't surprise you. There's always a surprise that costs more. There's always a change order that costs more. Number two, the nature of today's environment is on when you're doing like that type of work, there's a lot of work in the space today that is used to be tenant work, has now moved to landlord work. Now, some retailers are paying for that through rent. Others are working to get it out but it depends on if you're talking about a 500,000 foot center, sure. You start getting smaller and smaller centers to what's actually being built today, you're seeing some crazy costs. You want to talk about a 10,000 foot center with Starbucks, Chipotle, and Jersey Mike's, it's going to be expensive.
Oh, no, that's gonna be much, much higher. I don't disagree with you, and I will tell you that, some of the numbers that I've heard from some of our friends that we know well at larger format users who tend to self-develop, Costco, Target, Lifetime, the numbers are much higher for them for purpose-built facilities, and I do agree with you. The small stuff where I think a lot of people have made, a fair amount of hay in recent years, there, where you have to four-side the building and you need a drive-through and it's very prominent, so maybe the municipality wants a higher level of design. And you're doing small spaces, right? So lots of partitions, lots of demises, lots of ADA bathrooms, a lot of QSR F&B that has a higher HVAC demand. I mean, I think it's pretty easy to get up in the 500, $600 foot range
Bingo.
for sure.
Yeah, bingo.
No question. There's no question about it in that regard. I guess I was thinking more of the sort of, the classic perennial 300,000 foot, grocery anchored center or grocery anchored power center, where I think
Sure.
you can arb a little of it down, but there's nowhere you can look in the line items of developing a property today where costs aren't up, just really dramatically. And as my Econ 101 professor, who was actually a Marxist, used to remind me, he goes, Adam, he says, prices are sticky downward. It's easy for prices to go up. It's harder for them to go down. And I think that we've historically seen that in the construction industry.
For sure. the I'm going to bring it back. I said hold on, and we're talking about because we're talking about development. I said hold on to the one piece which you're talking about. You know, all this money that was made at essentially financial engineering deals, not actually adding real value to deals, and that was really catapulted by the low interest rate environment that we were living in for so long. Um, these things don't last forever, rarely do. The But at the current moment, the financial engineering to just make a deal work, that on the table today if you wanna get deals done?
It really comes down to the seller and their motivation, Chris. At the moment, if a seller, for whatever reason, is highly motivated to transact at what the market tells them the property is worth, not what they were told the property was worth 18 or 24 months ago, not what some appraiser may tell them on paper the property is worth. But if a seller is willing to transact at a market value today, as defined by an open process, I believe that some groups can get deals done. And the caveat there is, um, the capital markets are not open to everybody, and the capital markets at the moment are favoring the more sophisticated, larger sponsors, of which we are one. But for a qualified sponsor, and with a seller who will sell at market, I believe that you can generally get a deal done. Not always. The market, because of the the reduction in the amount of overall capital available for commercial real estate at the moment, largely having to do with interest rate and other factors completely outside of the retail real estate world. There's less capital available. So that capital can afford to be more selective, and it is being more selective, which is why the quality of the operator frequently now becomes the gating issue as to whether you have a deal or you don't have a deal between a buyer and a seller. And I think that will continue for some time. I don't envision, even when the Fed relents, for lack of a better term, that the Fed is just going to all of the sudden, the world is not going back to the interest rates of late 2021 and early 2022. And I think anybody who is out there either saying, "Oh, I can't buy now, interest rates are too high," or saying, "I can't sell now, I won't get fair value." I think those people, if they're waiting for, call it an 80 or a 90% return to 0% interest rates, I think they're going to be bitterly disappointed. That said, I do believe that somewhere down the road here, the Fed will take its foot off the brake a little bit at first. I think it'll be they're in no rush, right? They've shown that. And I think that, but at some point in time, interest rates will, for lack of a better term, quote unquote, normalize at some level between where we were and where we are today.
Got it. That was insightful. I would I would almost say that from a pure as it impacts your business perspective, you don't think it's the end of the world where interest rates are today.
Um, Short answer is yes. I don't think it's the end of the world.
With that, I want to move us to the next topic. Let everyone chew on that. Back to specific to retail real estate. Too good to ignore. A lot of talk out there about open air retail. Wall Street Journal's picked up stuff. You've been quoted in a lot of places. I'm out there on podcasts, LinkedIn, and what have you. But there's more to this open air retail story. One of the things that we touch on is we got a little more granular this year, and we are talking about the value retail space. And can you talk about the significance of value retail and its place in open air and how we think about that?
Sure. I look. I think we've always been focused on value. Our best retailer partners have historically been ones that are whose cultures, whose ethos is they're firmly committed to delivering the utmost value to the customer, to the consumer. We were our portfolio was made, on the strength of our relationships with people like Walmart. And when made my first Walmart deal, Sam used to have them put a sign on the front of every store that said, "We sell for less." Right? It's Walmart, it's Dollar Tree, it's Family Dollar, it's Dollar General, it's Ross, Burlington, all the TJ concepts, it's Five Below, it's Target. Obviously, look, you've made all these deals, you know who we're talking about. I think value resonates with the American consumer on so many different levels. And now that we've had this run up in interest rates and this run up in housing cost, rental costs particularly, and the run up in other costs to the consumer, value is, oh, I say to somebody that you and I both know well, value is always in fashion. And never has that been more the case than now. Particularly, there's such a wide range of tenants for whom this applies, whether it's Target or TJ, Carter's. It's also people who are providing services, and America's Best, I think, is a very, very good example of this. And the reality is that value is at the forefront of driving traffic because Americans like a bargain. They love to shop. Don't bet against the American consumer. You've heard me say it 100 times. And that's what's driving the traffic. Make no mistake about it. That's what's driving the traffic, right? The reality is that the amount of traffic that a Planet Fitness generates versus what an Equinox generates is pretty dramatically different, right? An Equinox gym may have several thousand members, and our top Planet Fitness operators have over 10,000 members at each of their locations. Think about how much traffic that generates. And that, I think, is a quintessential non goods, but services form of value. And, you know, all the good news in open air starts with traffic, right? If people come to the center, all of the math, all of the analysis shows they're going to spend more. They're going to spend more than they would spend online. They're going to spend more time than you think they're going to there, right? And they're going to cross shop, right? And they're going to get value. And that's going to leave money in their pocketbook to come back again. And I think that's an important factor, right? In many of our shopping centers, the average number of trips that the typical consumer in the trade area makes is approaching 3 a week. That's radically different than the mall, even in its heyday.
For sure.
And that's really the big driver. And I think that's where value helps beyond all else.
Yeah, value is always in fashion. I think that's a good line. Not to and when we say that, we mean it's always in vogue. Not we're not talking about value fashion per se, but value is in fashion. I think is an important note, just so no one gets confused out there.
Well, and never more so than now. I mean, how often now, you go on social media and some influencer or celebrity is seen at some event, right? And they may be wearing very expensive shoes or carrying a very expensive handbag. And when they're asked, the white t-shirt is or H&M or TJ, right? And, look at the value that places like Target and Walmart and Carter's and Marshalls provide working moms for children who are still growing. And in the time since I've had children and now grandchildren, the acceptance of buying clothes in a value outlet, in a value setting, not an outlet setting, but a value setting, a value brand, say like a TJ, has never been more accepted. There's no negativity to it. In fact, it's perceived to be smart, right? And everyone wants to be thought of as smart.
So true, so true. So to to wrap this up in a not so pretty bow, we one of the things that we wanted to hit on in this paper is retail's a big word, means a lot of different things. I could go into a dissertation on what's the difference between discount, off price, wholesale, this, that, the other thing. And then, we could talk about is Starbucks a restaurant? That's a debate that people can have. And I put it all in retail. Planet Fitness, Starbucks, TJ Maxx, all retail. Retailing different things. Some people are retailing services, some people are retailing goods. But the just like everything else evolves, it evolves. And what we're talking about is a sector of retail that has been successful for quite some time. And it is the majority of grocery anchor neighborhood and power centers in America are this brand or cohort of stores that actually are very focused on providing a dollar value to the end consumer, which is, you mentioned the influencer. I also see a ton of promotion on aspirational brands on of all product sectors that of prices going up, trying to be exclusive, which is not necessarily what is the majority of shopping that happens in America. That is very few and far between. And the majority of Americans and are looking for a value. And we're clearly seeing some of the trade down effects for this environment. But even when times were good 2 years ago, from an economic perspective, these value retailers were blowing the cover off the ball.
The consistency and the depth. You think about you go back and you think about in 2019, the last year before pre-COVID, what the average TJ did in sales, the average home goods did in sales, and you look at what they do now, the compound effect of these businesses delivering value to the consumer and being well run, right? I think, one of the things I think we're very fortunate in the value retail real estate space right now is we're really blessed that many of the value chains that drive traffic are exceptionally well run. I
I
mean,
agree. There's
you look at
operational excellence.
you look at the you look at who's running some of these brands now, and you look at the leadership teams at many of these places, and they are, first of all, they're super committed to the mission. They have realized that by investing in their teams, which was originally perceived to be expensive and potentially a negative to margins, it's actually turned out to be a positive for many of them because they've put a better product in the aisle to the customer. And what I mean by in the aisle is where the customer merges the good on the shelf, where we know there's immense value in a Target, a TJ, et cetera. Uh, but in the aisle is the merger of that and the service. And by having a better staff that's more incentivized, perhaps better compensated than they were just a few years ago, the customer's getting a better overall experience. And the top merchants, the Doug McMillans, the Brian Cannells, the leadership team at places like Ross, TJ, et cetera, have really locked into this, and it is creating a better experience for the retail for the consumer. And as a result, the consumer is creating more repeat traffic to the groups that do that well. I think as it relates to fashion, I think that we called this a long, long time ago, DLC, long before we started buying white papers. I remember you came to me one November and said, "We've made," I don't remember what the number was. "We've made 65 deals of non-anchor boxes in that particular year through no through October, November. We haven't made a single full priced apparel player, not one." And that's gone on now for years. And the reality is, if you sell full price commoditized apparel, and you are trapped in a bitter, vicious promotional cycle that you cannot get out of, right? We had two retailers file for bankruptcy last week. They were both in that category, right? One was Express, and the other was Route 21. And Route 21 announced today they'll be closing all of the stores, all 450 some odd stores. And to me, that comes as no surprise. I think we're going to be pleasantly surprised by how quickly many of those stores get taken up by other retailers. But in both instances, both retailers were selling commoditized, not, essentially full price apparel that was, it was not particularly, there was no reason that she wanted to go in the store and shop that store. And as a result, and by the way, also an overwhelming preponderance of both chain stores were in B and C malls, right? Which just exacerbates that problem. Hard to get in and out of, access isn't very good. Those stores don't work as fulfillment for online ordering very well. All things that value open air retail does extremely well. And I think we're gonna see that continue. And I think we've also seen, right, is the survivors in a mall setting, is more and more of these types of tenants go out. They say, "What am I doing here?" Right? I can be we have a bunch. Think about how many TJs and other brands like them, Burlington, TJ, Ross, Home Goods, we have in secondary or tertiary markets where that 25 or 30,000 foot store does more volume than the 100,000 square foot plus department store in that dying mall. So wouldn't you rather be between those tenants? And, in many of our centers, you also get the benefit of having a grocer. You get the benefit of having Target or Walmart. Maybe you have Sam's Club or Costco, Home Depot or Lowe's. Wouldn't you rather, and you have your gym right there with you, you can do it all at once. To me, the open air part has become more compelling on so many levels that I think that reaffirms my view about why we're in the early innings of a really renaissance kind of period for our industry.
What a great point about the department stores and the junior anchors in the open air space. It
Oh,
totally makes a ton of sense. Last bit here. I know you're a busy guy. Uh, the last piece, in Too Good to Ignore, we do touch on this suburban versus urban concept, in that we had this suburban migration. Millennials aren't going to live in apartments forever, and the people who did buy aren't moving anytime soon. and a pretty compelling case for, amongst a million other things for the suburbs. But uh, what do you think as this suburbs versus urban environment, especially as, you know, yeah, we're talking our own book a little bit, but we do own in primarily suburban markets.
Well, I think the story here is long overdue, but here it comes, and for a variety of reasons, it ain't going anywhere anytime soon. Look, the pandemic changed so much, and one of the things it did was it took things that were really delayed. I mean, the big thing that was delayed amongst millennials was household formation, which is a fancy demographic term for getting married and having babies. But let's face it, someone asked me about this last week. When I moved to New York City from college in 1987, the average two-bedroom apartment was 1,000 square feet. At the start of the pandemic in 2020, the average two-bedroom apartment in Manhattan had shrunk to 650 feet. Now, you could try and convince yourself as a millennial, yeah, I could have one kid in the city and it'll work. And, maybe we could even have a second one that's a baby. Go try and have two small children in a 650 square foot apartment. But,
No
millennials
thanks.
wanted to live in the city. They hung in. They wanted to defend their lifestyle, right? What's the famous line? I wanted to fight for my right to party. And then the pandemic came, and it's like, well, can I balance my laptop on top of the bassinet and then move the laptop to the stroller and not step on that toy and fall down and break my back and I can't go to the hospital? So a lot of people got religion very quickly about, hey, maybe the suburbs aren't so bad. And lo and behold, I'm going to get incentivized to move to the suburbs because interest rates are really, really low. And therefore, I'm going to borrow. And we saw so many people move from cities, and I'm not just talking about New York Metro, I'm talking about all over the country, to suburbs and lower their housing cost. Now, when my wife and I bought a house, all the disposable income disappeared, right? Our housing cost as a percentage of disposable income went way up because interest rates were 9, 10% when we bought our first home. But when you buy your first home and interest rates are 3 and you're paying big time rent in New York, Boston, Chicago, Miami, Atlanta, Los Angeles, very often your housing costs went down. More space, better quality of life, have room for a kid or two. And my housing costs went down. That's pretty dramatic. And then you couple that with the fact that hybrid came along from a work perspective, and therefore a workspace in your living space became a prerequisite, not an option. The suburbs became a lot more compelling. And for us, that's been very, very good news. It has driven more traffic to centers, particularly for uses that are daytime pop uses, gyms, QSRs, F&B, services. And we've seen really material rent growth in those subcategories, in part because their traffic and sales are up so much, because more people are around during the day in the suburbs than there used to be. That's number one. Number two, that suburban customers paying a historically low percentage of their disposable income towards their housing cost, it leaves them more money to spend, spend, spend. And they're the American consumer, and they are doing exactly that. They are spending. That's more good news for us. I think the good news will continue because now people who are locked into suburban markets with that 3% mortgage going to be very loath to move and give that up. Their personal finances are now geared to having that much space and paying that little for it. And as a result, I think the next benefit we get is that people will continue to want to move out of cities and into suburban settings, but they're going to have to move into more ex-urban ones, a little further out, a little more tertiary to take advantage since housing prices in close moved up and there's very little supply as a result of people holding on and turnover being less in those first inner ring suburbs. So I think people are going to move further out. And you look at some places where we own a little further out, like in the Hudson Valley of New York, as an example, or a little further out in the western suburbs of Chicago, or a little further out, say in a Lawrenceville, Georgia from Atlanta. And you're going to see, I think, a real uptick in both population, but also in average household income. because the people who are pushing out one further ring out are the people who used to buy in the inner, more expensive ring, but now there's no product. So they're moving further out and they're bringing a higher level of disposable income to those more exurban markets, which I think bodes extremely well for open air retail.
Me too. At the time, right? You could have taken, you could have borrowed the money, 3, 4%, whatever it was at the time, and then you could have went and got an I bond at 9% that they were giving you. The you could buy a savings bond at 9% at that time. It was a remarkable time in the world we were living in. There's no doubt. Uh, but it's a really interesting way you brought that whole suburban and the millennial demographic to the forefront here. And I think you gave everyone a lot to chew on, Adam. Really appreciate you doing this. Uh, thank you so much. Any last words for the listeners out there?
For our listeners who are coming to ICSC Las Vegas, um, I don't think you have to go in front of a mirror and rah rah cheer yourself up. I mean, the market fundamentals should make you exceedingly positive leading into the show. I hope everyone has a great and highly successful and profitable show because this is the year to do it.
All right. With that, thank you so much, Adam. Appreciate it.
Thanks, Chris, for having me. Always the best.
All right. Bye. Appreciate you watching. Hit subscribe. See you in the next one.